All right, let's dive right into this explainer. Grab your equity research analyst hats because today we are separating the absolute fundamental truth of Restaurant Brands International, or RBI, from the mainstream market hype. We're stepping into the role of investigative journalists of their financial statements, looking at exactly what is under the hood of this global fast food titan. No fluff, just a rigorous, data-driven analysis.
But before we tear down the financials, I need to read this exact mandatory disclaimer. This is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism.
Okay, here is our syllabus for today's deep dive. We'll quickly review the QSR business model, run through a rigorous Q2 earnings teardown, inspect their leverage and executives, evaluate the ESG moat, and then wrap it all up with the final verdict.
Section 2. The QSR business model. You literally can't value a house without checking its foundation first, right? For RBI, that foundation is anchored by two absolute titans in the quick service industry, Tim Hortons and Burger King. These aren't just fast food joints. We are talking about brands that have commanded deep, multi-generational, localized loyalty for decades. Tim Hortons basically fuels all of Canada, and Burger King is a globally recognized juggernaut.
Rounding out the rest of the portfolio, we have Popeye's Louisiana Kitchen and Firehouse Subs. These brands complete a global footprint that is, frankly, staggering. We're looking at over 33,000 independently operated restaurants spread across more than 120 countries and territories. Just think about the sheer logistical efficiency required to maintain quality across a network of that magnitude.
And here is the payoff. To put that massive footprint into perspective, it translates to nearly $46.8 billion in annual system-wide sales. So, what's the secret sauce? It's driven by a highly disciplined, repeatable operating system that completely relies on local ownership. RBI doesn't have to manage 33,000 localized labor forces, their franchisees do. That is the true beauty of the franchise model. It scales with incredible efficiency.
Section 3. Q2 2026 Earnings Teardown.
Now let's look under the hood. The consolidated top-line beats are genuinely impressive here, with a 6.4% growth in system-wide sales. But what really stands out to an analyst is the 8.5% comparable sales acceleration, specifically at Burger King US. Guys, that is a massive number for a legacy brand. It proves that management's strategy of investing in fundamental execution is actively paying dividends. And speaking of dividends, they returned a very solid $435 million to shareholders this quarter alone.
Looking at the brand-by-brand breakdown of adjusted operating income, which is essentially the core profit generated from operations, we see diversification doing exactly what it's supposed to do. We have double-digit growth for Burger King at 13.2% and the international segment booming at 13.2% as well. This outperformance easily offsets the slight 5.4% dip we see over at Popeyes. When one brand hits a speed bump, the others carry the portfolio.
But you know the old saying, right? Revenue is vanity, cash is sanity. Well, the absolutely crucial fundamental metric for us is this massive $1.4 billion in free cash flow over the trailing 12 months. This perfectly demonstrates the incredible cash-generating power of this asset-light franchise model. It gives the company immense optionality to pay those dividends, buy back stock, or pay down their debt.
Section 4. Leverage and executive alignment. A skeptical analyst never just looks at the revenue beats. We have to examine the debt load. When we look at the balance sheet, it's actually strengthening. Net leverage, their core debt relative to their earnings, has dropped from 4.6 times down to a much healthier 4.1 times over the past year. In a world where interest rates really matter, aggressively deleveraging while still growing the top line is exactly what you want to see.
Now, if you want the real story, you always have to dig into the proxy statement footnotes. That's where we uncovered this fascinating bonus swap program. Executives actually have the option to leverage 50% of their net cash bonus into matching stock units with a massive 2.25x multiplier. If they believe in the company, they literally put their own cash on the line for shares that vest over time.
This complex compensation structure ensures the C-suite has real, tangible skin in the game. It perfectly mirrors the company's stated core values of ownership and meritocracy. As an analyst, I absolutely love seeing this. It means the executives aren't just salaried employees, they are true owners whose personal net worth is directly tied to the very same stock performance that you and I are evaluating.
Section 5. The ESG moat.
Look, often ESG reports are just corporate fluff, but we need to evaluate if these initiatives actually function as an economic moat, and they aren't just greenwashing here. By integrating 9 pure electric vehicles into the Tim Hortons corporate distribution fleet across Canada, they are actively building supply chain resilience, they're lowering their exposure to volatile diesel prices, and creating long-term cost advantages. That is an ESG initiative with real, tangible financial ROI.
Furthermore, by embedding substantial community investments directly into the local operating models, they solidify deep guest loyalty. Raising over $50 million through Tim Hortons, or celebrating 2 decades of the Burger King and Firehouse Subs Foundations, these aren't just charities. They are deeply entrenched local ties that make it incredibly hard for a competitor to swoop in and steal market share. It significantly deepens their intangible moat.
Section 6. The final verdict. So we've torn down the top line, the debt, and the intangibles. Let's synthesize all this data. First, the valuation trajectory. Based on that robust $1.4 billion in free cash flow and a consistently deleveraging balance sheet, the fundamental health of the business is objectively expanding. They are generating $2.6 billion in adjusted operating income. This means the company doesn't need to rely on market hype or multiple expansion. The core economics alone suggests fair to strong valuation momentum.
Second, the economic moat. Evaluating this through a Morningstyles lens, RBI's economic moat is undeniably wide and looks to be expanding over the next 3 years. This is driven by 3 key sources: deeply entrenched brand intangibles, the efficient scale of operating over 33,000 restaurants globally, and the significant cost advantages inherent in their highly leveraged franchise model.
Finally, the nuanced takeaway. We've seen incredible comparable sales at Burger King and a fortified balance sheet. But remember, the fast food landscape is famously cutthroat, and consumer spending habits can shift rapidly. The models are pointing one way, but hidden macroeconomic flags always suggest a potential storm on the horizon. Which side are you on? Do your own homework. Thanks for joining me on this explainer, and keep digging into those filings.